Okay, so last video we looked at calls and puts and how they worked in a very like basic level and how you'd usually just like interact with them. But now we're gonna be looking at some strategies on how you can like manipulate and um basically just generate your portfolio in a way where you not only minimize risk, but you can also maximize your profits, which at the end of the day is what you want. So strategies can get really complex. So um, try to pay attention or try to just pause the video and like actually conceptualize what I'm trying to say because it can get really complex, especially because there are some points where you're both in a position of a buyer and a seller. But I won't bore you guys much, so let's get into it. So the first strategy we're going to be looking at is just your protected put. This usually goes with an asset or goes along with an asset. So say, and let's make a little graph here. Say your put's currently trading at let's say that again, let's keep with the same numbers. So let's say your put right now is at 90. Okay, that's you have it here, you're holding it here, but suddenly like there's a huge demotivation in the market or something, and you think to yourself, oh, I'm pretty sure this is gonna fall, or the price of this is gonna fall. So you think to yourself, okay, let's minimize our losses. So you go ahead and let's do, I think that's, so you put your bet again. Let's say you think this is gonna fall all the way down to 85. So let's keep your $2 bet. $2 bet. So what happens here? So again, if your stock just like stays here above 90, you're just gonna hold it and you're gonna lose your $2 bet. It's pretty, that's okay, because again, you're just buying the insurance so in case the following happens. So what happens if your stock suddenly just you have it here, you have it here, and then suddenly it dips and it dips all the way down to 60. So essentially the protected put would allow you to when the market hits 60, you're able to sell it at 85 and protect your losses. So at the end of the day, your profit is so you had it at 90 and you invested too is as well in order to protect your losses. So if you bought it at 90 and sold it at 85, so you bought it at 90, bought, and then you sold at 85 and it cost you $2, that's a -7 loss. But if you wouldn't have had it, you would have had 90. If you wouldn't have had your protected put plus 60 and then -2, that's a -32 loss. So as you can see here, this is what almost a 4 times difference. Or sorry, this does not go here. Sorry. This is nearly what 4 times the loss you would have had, or like if you did not choose to protect your asset. Well, here the most you can lose is $7 because of the cost of the bet and the amount of money you'd be able to lose. So that's just a quick and easy protected put. Remember that puts were kind of like insurance, and in this case you do have the asset, not like here where it doesn't necessarily mean you're holding the asset. Here you actually have it. Okay, next up we have the covered call. This is an interesting strategy because it's either used to just it's basically used to just earn a little like assured money from a stock you just purchased. So again, let's make our graph. Let's make our graph. We're gonna actually have these pre-made so you guys don't have to see me do them. So this one you own the asset. Similar to the protected put, you also have here that your covered call, you own the asset. So what exactly do you do? So it's pretty simple. So say you have your stock at 90 and you think to yourself, like I've analyzed the stock and the movement's not volatile at all. It just stays, let's say between like 95 and like 85. Let's say that's like what the trend has been. Market's not volatile at all. So you say, you know what? I'm just gonna label these as trends. So let's say you say, you know what? I don't think the stock is gonna rise past $105. So I'm gonna buy myself or like sell a call. So you're gonna write a call for somebody to have the option of buying from you. So therefore you have the obligation to sell if the person you're betting against thinks the conditions are favorable. So two things can happen. So the first one is you bet, right? So what would happen here? So the bet, again, standard $2, that's your premium. And that would mean that or sorry, for you to be right, you'd have the stock price, and I'm gonna put this in orange, would never cross 105. So even if it's like at 104, it's still better for the buyer of your option to just buy it outright from the market. But so here you'd get to keep your stock. So let's say it went up to 100. You still gained. So let's say the stock movement goes up here to 100. So stock movement. You still gained the $10 from, so like 100, which is the stock price. And then you had your 90, which is your purchase price. But the thing about covered calls is you're assuring yourself money by sorry, by the bet, by the premium. So you make yourself $2 per stock. So you make a $12 profit if you decide to sell at 100. What if and by the way, that doesn't mean you have to sell. It just means that, for example, if you were to sell, if the stock got to 100, that's your profit. But if you're just holding the stock and you're just trying to make something out of it, yeah, that's, you'd only have those $2 and you can do it again and do it again and do it again. So what if you bet wrong? Let's put a sad face because you bet wrong. So say, for example, and let's put this in purple. Suddenly there's just like a crazy thing that happens and the stock price skyrockets all the way to like 110. So let's say the stock skyrockets to 110. So technically nothing wrong happens here because you're still gonna go ahead and sell your stock at 105 from a stock you bought at 90, and you earned yourself the $2 bet. So you're still making a $17 profit per stock, But the bad thing here is, and the main cost here, and let's put this here, is main is your opportunity cost. Because, and here you're going to see it in a second, you could have sold it at 110 minus your 90 of cost. And here you wouldn't have a premium because you didn't make the bet. So you have 110, it's $20. So this could like be blown completely out of proportions and just like and like again, share contracts are I think 100 stocks each. So this would be what, like $2,000. But just smaller numbers are easier to explain and better for mental math. So this is kind of what it looks like. You're just betting that the asset's gonna move up and you're gonna, or sorry, you're selling the right to buy and having yourself the obligation to sell if the market is favorable. But you're still gonna earn something out of it. The main cost in a covered call is your opportunity cost, but covered calls are mostly used in something called a buy right. So let's put this, a buy right. So say you're buying $100 worth of stock. And let's put buy. Oh, the buy. But let's say like, oh, I don't want to invest that much, or I don't have that much, like, I need more cash for liquidity, whatnot, whatever. So what the covered call allows you to do is essentially say you make a $5, you sell a $5 option. That means you actually got the stock for, you actually got the stock for 95 because by selling the option, you're immediately getting a premium. So that lowers your cost. So that's a quick intro to covered calls. It's just your main loss could be opportunity cost, but you have pretty much everything to gain. But it's those situations where if you were to lose, you'd be like, oh no, like I could have definitely made more money, but you're still gonna make money, and you could even save yourself money from your initial investment. So that's why you use a covered call. So next up, we have the straddle strategy. I pre-made the graph, so I hope you guys are happy with that. So this strategy is when we are actually starting to mesh calls and puts in order to get something out of it. So this one you don't necessarily, oh, I'm still in shape mode. Don't have to have asset compared to the previous one where it's like implied that you do have it. And here you're buying both, and let's use the colors I'm going to use for the graph, a call and a put. At the same price and at the same time. So sorry, my roommate came to say goodbye. He's leaving for the holidays today, so I don't know where I was, so apologies for that. But essentially you're buying a call and you're buying a put at the same price and at the same time. So what you mean by this is that you're gonna bet the guy, and my call's it green. So you're gonna bet the guy that in say 3 months is gonna be 90, and again, in your put, your price is going to be, ooh, that's a horrible arrow. It's also going to be 90. So you're thinking to yourself, well, why do you do this? So say your stock, and let's go back to our orange, the first stock movement. I think that's it. I don't know. I tried to color coordinate the videos, um, so you guys can like follow along easily, but I often get lost because I don't usually study like this. But say in 3 months, suddenly the stock is trading at 110. So you go ahead and um you purchase your stock at 90, you sell at 110, and you discount your bet for $2. So that's what, 18. But so you're thinking to yourself, oh wow, there is absolutely no way I can lose money here, because in 3 months I have the exact same price. Or sorry, in 3 months, whatever happens, I'm gonna gain money, because what happens if um the market goes down to 70? So you're gonna go ahead and purchase at 70. So let's purchase at 70. You sell at 90, and you subtract your bet, and you still have your $18. So you're thinking to yourself, wow, there is truly no way to um lose money here. But incredibly, the risk here comes with the premiums and with the bets you're making, because there's something in the market, I'm pretty sure it's called implied volatility, which essentially means with this strategy, in like a actual portfolio, you need the market to be extremely volatile for you to make money out of it. So I'm just gonna make the graph. Okay, I had to take a break because I realized that I wasn't um recording my voice. So essentially, what I was trying to explain here is the fact that you need a lot to happen um for the market to actually, or like for you to actually um gain any sort of money in this, because if, and this like requires a bit of thinking, but if the market has been trending at 90, and it hasn't been volatile at all enough for you to think, oh, in 3 months it's gonna stay at 90, that means that in order for you to make some money over your premium, the market's gonna have to move a lot. So even if it's something small like 90 to 92, that's still quite a lot of percentage that needs to change. So the graph ends up looking a bit like this. So the closer you are to your to the date set for your option, the more you need the market to change. So it could even get to like 15%. And this is just this is no numbers. This is just trying to explain the theory. These numbers, I just made them up as I went. Um, and as you can see, like here, even like in the first day, you need like a percent change of 3% in order to actually start making some money. um and the further you go into the option, the more you need, the more you need it to change in order to um for you to actually start or for you to actually make a profit. And there's a point here at the date of expiration, where if you let your options expire, um you're going to lose 100% of your investment, which was of $4 in this case, because your investment's $4 for both call and put. And currently you're thinking to yourself like, oh, it's $4. It's not that much money. But if you're dealing with 10,000 stocks, that's $40,000 you're losing if you don't bet properly. So it is in on paper, it looks like a very like easy money strategy, but in theory, you really need a very volatile market for this to actually work. And if you're sure that in 3 months the stock price is going to be exactly the same as right now, that already tells you, oh, the market does not move that often, does not move that much. And therefore I am taking in a lot of risks saying that it's going to move up or down enough for me to actually make some profit. Because say, for example, your bet's of $5, that already you needed to move up to 95, which means that is a what 5 over 90, that is, give me a second, that's a 5% change that you need in order to just break even. Now to make a profit, that's something at least 6%. And again, if in 3 months you needed to be greater than that much money, it is a lot of risk you're taking in. So that's why the straddle, like on paper it looks amazing, but in theory, like it is a very risky strategy. So yeah. Okay, so this one's really interesting because we're looking at a spread, and more specifically, we're looking at a bullish spread. What this means, there are many types of spreads. I don't necessarily know everyone. I heard one that sounded very cool, which is the Iron Condor. But frankly, you don't need to know that. This is just a simple bullish spread. And you're essentially buying and selling a call, selling a call with, so you buy call first, then sell it at a later date with higher price. So how does this look? And this one's really interesting because say your stock right now is currently at 90. So 90, and you think to yourself, oh, I'm just gonna go ahead and like I think this stock's gonna go up. By the way, this one you do not need to actually physically own the stock. So I think that this stock's gonna go up. It's gonna go past 100. So you think, oh, it's gonna go past 100, and I'm willing to bet $2 that P in 3 months is gonna be, that's your bet. That's what you're saying. Your price in 3 months is gonna be $100. So what do you do next? So let's say, and let's use our stock movement. So let's say the stock goes up and it reaches 105. So let's just go ahead and put this here, 105. So you'd go ahead, exercise your option. So you buy at 100, you take into account your bet, but you have your $105. So you made a $3 profit. So what do you mean by you sell an option later? So you're thinking to yourself, oh, this the stock's gonna keep rising up, but honestly, I just want to make a little bit of money. I don't want to make that much money. So what do? Well, you go ahead and sell. So you have your obligation to sell. You sell a call you sell the right to buy. So you sell a call at 110. So let's put this here. So let's say the stock keeps going up and it goes up to 115. So this a person you're betting against is gonna think to themselves, oh, perfect, I can buy it at 110 and sell it at 115. And I can make some profit out of it. So how does this look? So here, technically, you're buying at 105. You are selling at 110. And let's say that this guy bet you $3 or $4. So you earn yourself $4. So S4 that was bet against you. So you sold at 110 minus 105, that's 5 plus 4. That is $9 of profit. So essentially here you're basically what you're doing is putting a cap on how much you can earn. So this is similar to the covered call in which you're just placing a ceiling. But this is usually made in order to finance. So again, and here's where we start looking at the max loss and the max profit. So your max loss would be your original bet. So let's put original bet minus the price of your and by the way, the numbers are not going to work, but I'll explain it. With your second bet against. Technically, this is the other way around, but just ignore it for a second. So let's just ignore it for a second. Anyways, I'll explain and it'll make sense. And the max profit is the difference in strikes. In strike minus this is called the net premium. So this is I'm just gonna put difference in bets because we're calling the premiums bets. So how can you lose money on this? So say for example that I don't want to delete that because then I'm gonna share this. How do I do this? Okay, let's just change color. Say so you have your first one here. You bought a call option. So let's say that the stock didn't go past 100. Let's say it peaked at what, like 95. So you did not exercise your option. So usually you just have a $2 loss if let expire option. But you're thinking to yourself like, oh my God, I lost. And by the way, in the context of 10,000 stocks, oh my God, I lost $20,000 on this bet I made. So how can I minimize my loss? Well, you can sell and you can put yourself in the obligation to sell by selling the right to buy. And you can tell yourself, oh, well, if my bet for the $100 for the second one was 4, then I am gonna make $2 and finance and I'm gonna finance the my first bet with the second bet against. So as you can see here, this guy, the guy you're betting against, won't exercise his option if you didn't even exercise your first one. Because if the stock stayed at 95, he's not gonna exercise his option at 110. It just doesn't make sense. So he's gonna let his contract expire, and you're gonna gain from other contract expired. So you're gonna gain that from the other contract expire, and your bet originally was $2. So you're gonna make $2. This is usually offset because it is most likely that the option you're selling is gonna be at the equal price, or you might lose $1 or something. It all depends on how the contract looks. But at the end of the day, this is how it looks. So you're using the sale of the option later in order to finance the first one, and you're basically putting the cap on your you're putting a ceiling on your option in order to finance it, but you're still gonna make a pretty good profit, which is the difference in the strike price. Because you you bought at 100 and then you sold at 110. That's still $10 profit per stock. You could have easily sold it at 120 and made $100, or sorry, $20 or even more. But there's still a lot of inherent risk if the stock tags or something. So you're just putting a ceiling, but you're protecting yourself in order to not spend that much money. And in case of any market volatility, because for example, the market could peak at 105 and you sell it at 105, you make $5, and then suddenly it peaks at 105, and the guy you're betting against won't exercise his option, and you'll make those $4 of the bet. So that is called a bullish spread. It is pretty complex to wrap your head around, but this is essentially a bit of how it looks like. I hope I'm not like confusing you guys with a lot of the wording, but just remember, you're putting yourself a ceiling in order to either finance it or just protect your losses. Okay, we had to start over there because I completely botched it. I got confused, and I forgot how this thing actually works. So this is not necessarily or like it is not necessarily something to make money. It's similar to the protective put, as you're basically just getting your insurance in case to protect yourself from further loss. So again, this consists of buying a put and selling a call. And here you have your $80 put and then your $100 call, $110 call. Let's actually make this 100 so we work in tens. And you sell a call at 100. So how does this actually work? So you currently have your stock at $90, and you're thinking to yourself, oh no, the market's gonna go under. I think I'd rather protect myself and pay a premium rather than lose a bunch of money. So let's say the next day, so you get yourself a put at 80. So that's this right here. You get yourself a put. So what happens? So the next day, say the market, so it's at 90 and it suddenly tanks and it goes up to 70. So you go ahead to the guy you bet against and you tell them, hey, I want to sell my stocks at $80. So you bought these at 90, you sold them at 80, and this cost you $2. So that was a $15 loss versus what could have happened if you didn't have it. You would have sold it, you would have had that, and then you would have had to sell at 70. This means you had a $20 loss. And this right now, you're thinking to yourself again, oh, but $5 is nothing. But like in the context of 100,000 stock, that's a lot of money you're losing. So it's a bunch of money you're saving yourself in case like you think your position is going to drop. But suddenly, let's say tomorrow the market decides to just fix itself or just like go crazy. And again, the reasons, I don't know, it's just easier to explain. So let's say suddenly the stock rises up and it decides to get to 110. So again, you're still going to make a profit out of the 100 because you bought at 90, you sold at 100, and you also made, let's say this was also $5, and you made those $5. So you made a $15 profit. So if it was 110, again, this is your opportunity cost loss. So you have 110 minus 90. That could have been a $20 profit. So what the caller essentially is telling you is that you're building yourself a collar with how much money you can lose and how much money you can gain. So the max loss you can achieve is if the purchase price minus your put strike minus your premium or your bet, and then your max profit is going to be the call price strike minus your purchase price plus your bet. So you're essentially just keeping yourself within that collar. And if you remember correctly, these are strategies, or that second selling of a call, that's not just because you're thinking to yourself, oh, I just want to limit my the amount of money I want to make. Because again, like, why would you want to do that? So essentially the selling of the call offsets this, because look, this and this. So your put cost is $5. That is a horrible 5. And then your call sell, you $5 cost, and so these cancel each other out. So you're not using the selling of a call, and you're not putting yourself in an obligation to buy just because you want to. It's mostly because you want to finance your insurance, essentially. So that's a little bit of the collar. As you can see, that is the collar itself. And yeah, that's a very quick recap of stock strategies.